Treatment of problem. Okay, the initial recognition of the investment fund injected by UPC is the first problem. Okay, the different viewpoint of UPC and MIM regarding the initial recognition of the injected fund has created a problem. Okay, in the perspective of MIM, it is considered as an equity. Okay, this is because MIM view the injection of fund as a usual additional capital funding by the parent, and it was not the first time that the parent has done this. Okay, in addition, the investment decision was influenced by the parent. Okay, after all, MIM is a unique vehicle for the parent to generate income. However, in the perspective of UPC, it is a liability. Okay, the parent was resolute about not recognizing the injection of fund as an additional capital contribution. It arose from the desire to reduce MIM financial reliance on the parent. Okay, UPC Board of Directors was only willing to offer MIM a short-term financing arrangement. After all, the investment prospect was promising. They believed that MIM would be able to repay the fund injection from the investment return. Besides that, the parent external auditor also deemed that it is not a capital contribution. Okay, the next issue is the solvency of MIM. In the year 2019, the external auditor drew attention to the material uncertainty related to the going concern of MIM. Okay, the independent auditor stated that in their report that they drew attention in the note 2 in the financial statement. Okay, which disclose the premise upon which the group has prepared its financial statement by applying the going concern assumption, despite the fact that there is a net loss of RM 3,616,321 during the year ended 31st December 2019 as of that date, the group current liability exceeded its current asset, indicating the existence of material uncertainty which may cast significant doubt about the group ability to continue the going concern. Okay, thus there is an issue related to solvency of the company. Causes of problem. Okay, for the first problem, the problem of the initial recognition of the investment fund injected by UPC. Okay, this problem arises as a result of the lack of emphasis placed on the form and terms of the agreement. Okay, as UPC and MIM are preoccupied with the primary concern of having enough cash to acquire and seal the investment agreement. Okay, furthermore, the relationship between the UPC and MIM and the control of power used by the parent's company to make the MIM to take the investment has resulted in a problem with the injected fund initial recognition. Okay, for the second issue, the issue of the solvency of MIM. Okay, in the maintenance of capital, the redemption of preference share to occur, a company will have to prove their solvency. Okay, the problem with the solvency of MIM is due to the group net loss and the group's current liability exceeding the group current asset. Okay, moreover, this was also caused by the bank loan and the recognition of debt for the investment plan, which has resulted in significant drag on the company's solvency. Okay, as previously stated, the injection fund by UPC was recorded as a current liability. Okay, the recognition of the fund injected as a debt have put a strain on MIM, thus resulted to the issue of solvency in MIM. Decision criteria and alternative solution. Okay, for the issue of the initial recognition of the investment fund injected by UPC, there is two alternatives. For the first alternative, examine and understand the recognition of the investment fund injected by UPC through the suggested approach by IASB. Okay, debt and equity securities were considered financial instrument under IFRS 9. From the standpoint of both the holder and the issuer, these are financial instruments. Investment in subsidiary, associates, and joint venture fall into this category because it includes both debt and equity securities. It is difficult to determine whether it is an equity instrument or a financial liability. Okay. In this case, the injected investment fund by UPC, it was termed a redeemable convertible cumulative preference share RCCP. It is to be classified as financial liability as a feature of the RCCP. However, MIM need to determine whether the UPC injected fund is really liability or otherwise an equity investment. Thus, to ensure that the initial recognition is correct and following the standard accounting practice, the MIM should follow the IASB suggested approach in classifying financial instrument as liability or equity. Okay, the MIM can examine the future of the financial instrument through the distinction based on amount future or distinction based on the time future. Okay, for the second alternative, the company can consult with IASB related to the recognition of the investment fund injected by UPC. Okay, the company can receive advice on the recognition of the financial instrument, whether it is an equity or liability. Okay, the IASB will provide an alternative such as what suggested approach can be used for financial instrument classification, or they will assist in recognizing the classification on behalf of the UPC and MIM. They will also include an explanation for why they propose the method or why the recognition result is like that. Okay. The explanation will also include whether the parent's relationship with the MIM, the parent's control of power, and the MIM's reduction in reliance has an impact on the classification. Furthermore, the IASB will advise the company to always pay attention to and emphasize the recognition and measurement of the investment fund. As a result, it will be discovered why the classification is classified in this manner and solve the confusion of the party related to the classification. Okay. For the second issue, the issue of the solvency of MIM. Okay. For this issue, there is also two alternatives. For the first alternative, it is financial analysis. Okay, financial analysis can determine whether MIM are solvent or not solvent. Okay, one method of assessing a company's solvency is to compute ratio from financial statement data and compare them to those of others company or competitors or the market. Okay, the company can refer to ratio analysis, which includes solvency ratio that measures the company's ability to meet long-term obligation. Okay, other ratios such as liquidity ratio must also be examined to determine whether the company is solvent. Okay, this test can determine whether a company is solvent or not because the ratio indicates the company's wealth, ability to pay debt, and others important factors. Okay, the second alternative is to consult with financial advisor. Okay, the MIM can seek advice from a financial advisor to find a solution to the problem. Okay, the financial advisor will advise or guide the company on how to ensure that the company remains solvent and how to demonstrate that the company is solvent. Okay, the financial advisor will also include a financial approach or method for the solvency issue. Okay, for example, if the MIM is concerned about remaining solvent, okay, the financial advisor will advise the MIM to sell some of their asset or to reorganize the company expenditure. Okay, meanwhile, if it is unclear how to demonstrate that the company is solvent, the financial advisor will advise the company to conduct a financial analysis. Recommended solution, implementation, and justification. For the first issue, the issue of the initial recognition of the investment fund injected by UPC. Okay, for the solution, the MIM examine and comprehend the IASB recommended approach for recognizing the investment fund injected by UPC. Okay, the MIM can examine the future of the financial instrument using the distinction based on the amount future or the distinction based on the time future in the suggested approach to determine whether it is an equity instrument or a financial liability. Okay. For the contingency plan, in the future, maybe there is a certain feature of the financial instrument that are difficult to classify and it can make it hard to use the suggested approach. Thus, the company can maybe consult with IASB officer. Okay, the justification. Okay, through the approach suggested by IASB, it can ensure that the recognition of the injected fund by UPC is accurate and in accordance with standard. Okay, using the IASB approach, MIM can demonstrate significant evidence that the investment fund injected by UPC is classified as either a liability or an equity, and neither party can influence the decision of the classification based on their personal perspective. Okay, as a result, it can solve the problem of the parents and MIM differing perspective. Okay, for the second issue, the issue of the solvency of MIM. Okay, for the solution, financial analysis is used to determine the solvency of MIM. Okay, ratio analysis such as solvency ratio, liquidity ratio, and others ratio can be used to determine the company's solvency. Okay, this is because they provide information about the company's ability, the health of the company, and others that are deemed important to influence the solvency. Okay. For the contingency plan, okay, the attention to detail required by this analysis may result in errors if someone who is not detailed enough is assigned to the task. Okay, so the company must ensure that the employee who conduct this analysis is a detail-oriented individual. Okay, for the justification, in this case, the group's current liability exceeding the group current asset. Okay, this is accordance to the liquidity ratio stated that if the company liabilities exceed the value of its asset, the company is likely to be insolvent. However, the company cannot conclude that they are not solvent solely based on this information and ratio. Okay, the company must also analyze other ratio to determine whether or not the company is solvent.